we'll be talking about that and some more traditional methods of debt that you may take on. We'll be covering some key terminology to help you understand the key questions that people are asking you, and being able to have a educated conversation with your potential investors. Some of the pros and cons about taking outside investment, how to figure out how much money that you should even raise, and we'll also be talking about what do investors look for when they're evaluating startups. So you want to make sure that you're covering that material and trying to build momentum with your investors. And then lastly, we'll give a quick update about the Jobs Act, which is enabling equity crowdfunding to happen in the U.S. All right, so what are all the different ways that we can raise capital? You know, it's still the case that we are entrepreneurs are most popular in the very beginning days. It's bootstrapped. You're putting money on your credit cards. You and your co-founders are putting in some of the early money, and friends and family. And once you've kind of started to prove out your business and you've got an idea of how you want to scale your business, that's about the time where you can raise outside capital. And the time you know that you're ready for outside capital is once you've kind of proven your business model and you've identified your customer product market fit. You know who your customer is, you understand their pain points, you've proven that people are willing to pay for your product, and now you're ready to scale the business. And then you can go out for outside funding. So what are the different ways of getting outside funding? My favorite always is customers. You know, nothing beats sales because you don't have to dilute yourself, and you can bootstrap the company. So the more you can generate through revenue, the better. Now you're likely to need outside capital if you're building a high growth startup at some point. And so as you're moving into those options, you can look at accelerators. So accelerators will provide some early stage capital and mentorship. These are great, particularly for first time founders. VC, venture capital is widely popular, and you typically want to be a little bit further along with going to venture capital. I would say somewhere north of $1.5 million, and your business really has to be de-risked. And by that I mean the money machine has to be set up and proven. You have to be able to go to them and say, if we put $1 in, we're going to get $2 out, and here's our plan, and here's our history and track record of showing that. And then the other way, which we're going to be talking more about today, is equity crowdfunding. And basically what equity crowdfunding is where it's similar to doing the offline fundraising, except you're tapping up a whole new network of investors that you otherwise would not know. So for example, when I was raising on Onevest, before joining Onevest, I got investors from Boston, Hawaii. We even had an inquiry come in from China and Australia. We ultimately brought on investors from Hawaii, Boston, New Jersey, and Washington, D.C. And right under my nose here in Washington, D.C., but I didn't know them. So that's really the power of the platform on Onevest, where we have over 15,000 investors who are interested in making early stage investments. And so that the best equity crowdfunding platforms will curate the ventures and help them market themselves. So we'll do marketing on your behalf. We do email marketing, we do digital demo days, we get the word out to our partner network, and so there's a marketing benefit, and then it's obviously the investors that you can connect with right online. So just like you're finding friends and contacts on LinkedIn, and you reach out to them, you do the same thing on an equity crowdfunding platform like Onevest. So this is to illustrate what is really sort of the most prominent sources of capital. So founder money is really still the most popular. The nice thing about having a co-founder is you can pull together sources from multiple founders. That's what we did when we first launched Co-Founders Lab. My co-founder and I put it in the first dollars, and after about a year, then we went for outside capital. Believe it or not, credit cards are very a prominent source of funding the company in the early days. Another side benefit of credit cards is you're building your company debt or your personal, excuse me, your personal credit or your company credit, which comes in useful for getting future access to credit. And then friends and family and banks the equity crowdfunding is a brand new space, so we're not representing that on this chart. So some key terminology. So let's start with the terms of equity crowdfunding. You have donation-based crowdfunding. This is typically your Kickstarters and Indiegogo, where you might get the first product off the assembly line, or they might get you a T-shirt or send you a poster or something like that. What we're talking about today is equity crowdfunding. The investor puts in money and takes a percentage of equity into your company. Another term is your cap table. You want to get very familiar with that. This is your capitalization table that represents who is owners inside the company and what percentage of the company do they own. So the founders may own some stock, shares in the company for the work that they've been doing, maybe some sweat equity. They might have put dollars in, and as you raise multiple rounds, your valuation should be going up. So the cap table will capture the valuation of the company, what's your company worth, and who owns it, and all the shareholders. The valuation is just that, the value that you place on your company. That emerges over time. You want to have objective methods of establishing that and updating your valuation based on your traction in the market, the revenue that you have, your management team. All of those are factors to establish your valuation. A term sheet is essentially the framework of what the investment would look like. So you'll usually get a lead, let's say a lead investor who will establish the term sheet with you, or the investor might say, hey, I'm very interested in if you're using Onevest, typically you'll have your term sheet ready, and they'll say, hey, please go ahead and send the term sheet. That's when you actually jump out of your seat and you hug your teammates and shout excitedly that you have an interested investor. So that's a very good sign, and that's when you're going to start really picking up speed, negotiating the terms of the deal. For example, what's the valuation? How much are they going to invest? If it's a convertible note, when does the note expire? And so the convertible note is another way to issue equity, where rather than agreeing on the valuation, which can be a bit contentious, especially in the early days. We have to go based on sort of comparables. It depends what part of the world you're located, the industry. So there's a lot of variables there. And by issuing a convertible note, you can defer the decision around establishing the valuation. And essentially what you're doing is you're issuing debt. So let's say I could issue a $150,000 convertible note to the investor. On that note, it would say, I will pay you interest. The note will convert, let's say mature within 18 months or 36 months or whatever you guys come up with, and it will, and at that point they will call the note and you have to pay them back, or hopefully you are converting that convertible note into equity. So typically everybody's going into that conversation expecting that you're going to convert the note based on a trigger. That trigger is often a qualified round of financing. So they might say, that you raise $400,000 or $500,000, or you're going to say, you might say, we have reached a particular milestone in our revenues. And so you'll establish those terms in the convertible note. Dilution is what happens when you raise additional money. Dilution also happens as you're issuing more stock options to employees, but generally it pertains to raising additional capital. So when somebody invests more money, everyone in the company is getting diluted. Now, it sounds worse than it is, because as you're raising more money, the valuation of your company ought to be going up. So as long as you're in a healthy clip increasing the value of the company, it's not necessarily a good thing unless you do a down round. And then there's the type of stock. So if it's a large or lead investor, like they're taking, let's say, 25% of the round, they may demand preferred shares. And so preferred stock has voting rights, and they have other preferences that allow them to take sort of a first right of refusal on future on future deals. For example, they might say, in the event that we get a offer to purchase the company, that's a board decision, and or that's something that the preferred shareholders must be in unanimous voting on, or the agreement on. Or they might say that it has to be the majority of the preferred shareholders. So it usually has concessions on the voting, and also how your shares are treated in future, and sometimes they'll include like an anti-dilution clause in there for the preferred shareholders. Most of the investors smaller investors, let's say you're doing investments on Onevest, I think it's more common that those investors are going to be common, unless again you have one really large shareholder that might request that. All right, so we're going to take a quick poll and see if you've raised, how many people out there have tried raising money for your startup. So we'll go ahead and launch the poll now. If you can go ahead and click your answer there. We've got about more than half the answers in, so this will just be a few more seconds. And so we have about 40% of the respondents, and almost all the votes are in here. I'm going to close the poll, and it looks like it's a clean 60-40 split. So we have a few people, minority who have raised funding, and the majority who haven't. So that's great, and we can we'll try to pace some of our content accordingly. So one of the questions that people always ask is, how long does it take to raise capital? Well, if you're if you have raised, let's say you're raising $500,000, typically you'll want to have raised about 25% of your round offline, let's say, before you come to an equity crowdfunding platform like Onevest. Once you come to the platform, in my example, I was actually able to get commitments within 60 days. It kind of dragged on for final contract negotiation. I got caught in the holidays, so technically it was a little more than 3 months. But really, once the commitments came in, it was within 60 days. So equity crowdfunding, which is one of my favorite benefits of it, is it really saves you a lot of time and accelerates that process. So affording you to get back to business. And so generally, I think if you're looking at VC and you're raising a larger round, like let's say $1.5 million, $3, $4 million or more, then I think you want to budget probably somewhere between 4 to 6 months at least, and it's not uncommon for it to take closer to 9 months. And so depending on the method that you're using and the stage of your business, so the hotter you are, the more momentum that you have, depending on the market that you're in, the reach of your network, the referrals that you're getting, there's a big variation there. But there's a great study, it's hard to make out on this chart, that by Oxford Business School, that you can search for, called Anatomy of Seed, and they'll explain how long these various methods take. All right, so let's talk about, should I even take outside investments? So what are some of the considerations? Well, the good things are that the more money you bring in sooner, the faster that you can make your hires. You can launch into new markets. You can launch new versions of your product. You can experiment with various marketing channels. Maybe you want to try paid advertising. Maybe you want to do channel marketing. You can just do many more things that can, and it always takes time to experiment and then once you find a couple things that are working, then you want to really kind of double down on those. And if you can establish a good relationship with your investors, they have a lot to gain. And so the more you can kind of brief them and bring them into the challenges of the company, you can get some really great support. I always think, of my investors who have made introductions to customers and partners and other follow-on investors. They could be tremendously valuable when managed well. The cons is that you are giving up some ownership. So if you don't think you need money and you can kind of bootstrap your way into it, or you're just not, if you're more of a lifestyle business that's not going to be a high scaling company, you may not need to take outside capital. Another consideration is that you are diluting yourself and your shareholders. That's a double-edged sword because on one side you're diluting yourself, but the benefit is that you're going to be able to grow your company more and perhaps have a larger valuation. All right. So how do I decide how much money to raise? First, I would think about the benchmarks that you're trying to reach. So maybe it is, we need to get our product, we need the iPhone version of it, and we expect the sales to reach X amount, and from there we can start to get a little bit of cash flow, and we need 3 developers to get us there, a designer, and a couple biz dev folks. So you want to kind of look at the benchmarks that you have, and that's really the ideal way to go about is say, what is it going to take to kind of get into break even? Would be a great approach. Say, here are the things that we need to break even. We need to be in this many markets. We need to put out this, multiple versions. We need to have this many customers. Figure out your business model, the unit level economics, and then take just as much money as you need to get there and hit those milestones. Another good rule of thumb is just about 18 months. I mean, you want to give yourself enough runway. There's always going to be surprises, so you might want to give yourself a little bit of sort of wiggle room there by adding, let's say, a factor of 25%. But I'd say, giving yourself about an 18-month runway is a pretty well accepted practice. So what do the investors look for? The first thing they look for is team. The second thing they look for is team, and then they look at the idea. I can't stress enough how important it is to have a team that's passionate, resilient, they have grit, they have experience, they have domain expertise. If you've got some people on the team that have had startup experience, that's really going to count for a lot. The team is so important. Then you're looking at the idea. Is this a pain, a big enough problem that needs to be solved? Is the pain bad enough that people are going to reach into their wallet and give you a credit card to pay for your product? And then your traction. And by traction, I'm not talking about Twitter followers or website visits. That might be that's helpful, but I'm really talking about customers that have signed up with you, partners that have signed up with you, and other distribution indicators that you have for your business. And then if you are taking outside capital, particularly if you're going to go for VC money, it has to be a large market. It can't be 1 or 2. It can't be like $100 million or less. I would say for VCs, they're looking for much bigger market opportunities than that. And then on the angel side, on the equity crowdfunding side, that's the nice thing is that we all sort of I feel like it's sort of become common for founders to think about I need to go get VC money, and in order to get VC money, I need to come up with a really big business. Well, really big businesses are inherently riskier to pull off, and because you have more competitors, more unknowns, a longer runways, tougher milestones to hit. But there are perfectly good businesses that can make returns for their early stage investors and have a liquidity event that could be in the 25 million range, in the 50 million range, in the 100 million range. And that's one of the things that equity crowdfunding, I think, really opens up, is for businesses that are perfectly, that even maybe a surer thing, you want to just get to sort of first or second base, and you can kind of pay back your returns through a more predictable exit. And then they're also looking for competition. Has anyone else validated that there's a need here? Are you a laggard in this space, or are you really ahead? If you're ahead, what is your secret sauce? What's your competitive advantage? Are there barriers to entry, and are your advantages sustainable? So when you create a campaign on Onevest, you're going to need to put together a pitch deck. When you're doing offline fundraising, you're going to need that pitch deck. So generally, you want to have an intro, some key statistics, and then show your financials. So in the intro, you want to talk about the general overview, what your company has been doing, what problem you're trying to solve, and how bad is that problem, and how have you validated that there are customers out there. This sort of lean startup methodology is great guidelines on how to validate that there is a real market problem that people will pay to solve. Then you want to talk about market stats. Who's the competition? How much traction have you gotten? And the market size. And then your financial projections, your unit level economics. Here's our customer acquisition cost. Here's our marketing budget. Here's our marketing plan. Here's our customer lifetime value that we can generate, and then making all of that add up to generate profits. And then what every investor looking for is that hockey stick, where it really takes off after a year or 2 years. And then you just want to explicitly ask for the money. I'm looking to raise $150,000. I'm looking to raise $600,000, and I already have $200,000 committed, and I'm looking. We're speaking with investors we expect to close by the end of November. And then you want to tell them how use of proceeds. How am I going to use that money? So you want to have an 18-month plan on here is what we're going to do. We're going to be hiring these headcounts. We're going to be opening these offices. We're going to be hiring lawyers so we can lock up these patents. That whole plan, your 18-month plan, needs to be there, so they have the confidence that it's being spent in the right places. And the more sophisticated the investor, the more you can get them involved with that process, so they can inform that. So now you have now you've raised the money. Now what? You want to begin communicating with your investors. Focus on the milestones that you set out, your quarterly milestones. Communicate those to your teammates, and celebrate, but not for very long, and get back to work and earn your keep with your investors, so you can get follow-on investments to continue to scale. So we're going to do another quick poll to see how familiar our audience is with the Jobs Act. So I've gone ahead and opened the poll here. So if you guys can go ahead and indicate how familiar you are with the Jobs Act that was put in place a couple years ago. President Obama was the main person behind it. Steve Case was involved, and many other industry folks. So looks like we still have a few more votes coming in, but I'm going to close the poll here in about 5 seconds. All right, we do show that the majority, about 70%, are not familiar with the Jobs Act. So we'll talk a little bit about the Jobs Act. So Title II happened last fall. In fact, when I was raising money for my last startup, I think we were the first to take advantage of it. I sent a tweet out at midnight when that title was enacted into law, which allowed you to publicly solicit. It was an 80-year ban that was lifted. Before, you could not go and hang a shingle out in public to say you're raising money for your startup. You could only go to people that you knew in private venues. I couldn't go onto social media on Facebook, send email newsletters, take an ad out in a magazine, whatever. You couldn't publicly solicit. So that's really changed things a lot, where you can now publicly solicit. So we encourage you to publicly solicit on Onevest. You don't have to. People are also on Onevest not publicly soliciting, but but we think you can improve your chances by really offering up a much larger swath of people that you can target. And so now that we can publicly solicit, the next thing we're waiting for, the other part of the Jobs Act. By the way, the Jobs Act has lots of things that have to do with immigration, and it's a pretty hefty act. But we're just talking about one segment of it, which is related to crowdfunding. And so with Title III, which we're expecting to happen by the end of the year, is that right now when you are raising capital for your startup, when you're publicly soliciting, which means you have a campaign on Onevest, you're sort of notifying people you're going to pitch events, then you have to abide by the rules. Which, and one of those rules is that you can only take investments from accredited investors. And accredited investors, you can see this on our website. You can go to learn.onevest.com and just search on accredited investors for the full definition. But it's basically people who the government feels are in a financial situation to take the risk of early stage investing, because this is definitely one of the riskier asset classes. And so you can so what the definition is that over $1 million in liquid assets or $250,000 in income annually as an individual. So we're expecting that when that happens, that should be a big game changer. So all those people who are watching Shark Tank, tomorrow's season premiere, one of the best most popular shows on Friday nights, and one of the sharks, Barbara Corcoran, who's one of our advisors, we all big fans of that, and there's a lot of people who are fans of that, and a lot of people like the companies in which they could invest in it, and they're just just regular Americans that aren't accredited investors. And so we can take that number of, right now it's 8 million accredited investors, which when the Jobs Act changes to Title III, any person can invest regardless of your income and financial situation. There will be some limits as to how much you can invest, and those details are currently being sorted out, and we hope to see the final rules by the end of the year. So Onevest, as you know, is one of the leading equity crowdfunding platforms. So what you do is the benefits are that you can promote your company to a large pool of investors who have indicated they want to invest in startups that are outside your personal network, and it saves you a lot of time and effort to do your prospecting. One of the things and this is a really big sort of a big force that's at work here, is that it allows you to pull together smaller investment amounts. And so what that does is, before equity crowdfunding, you had to go convince a few investors to write like $250,000 checks or more. And so that was a really big risk by those few investors. With equity crowdfunding, you may have investors who are investing $10,000, $25,000. We have people who have invested an investor who's invested $250,000 on our platform. But generally, the trend is that you're going to get smaller investments, which now you have sort of you don't have as big of a resistance to convincing the investor, because the risk-reward equation changes significantly when you have a lower investment. And you have more investors to pull from. You have more people that can be like one of our most of our investors that we got through Onevest. They're out now advocating to use our product. They're out making introductions to people in the industry that they already familiar with. So if you can find people from your industry, that's even better. So you can have advisors that you're going to discover. In fact, one of our companies, which just successfully closed their round, they were able to find an investor who is now an advisor to the company. Another one found an advisor through, which right now is on Co-Founders Lab, but you'll find that you'll bump into it through Onevest as well. But you can find advisors, whether they're investors or just non-investing advisors. So the bigger you can kind of build your network of stakeholders and champions to help you to draw on their experience and their connections, the higher chances of success you have.